Oil at $108. Trump declared victory. Your wallet is still burning. Operation Epic Fury's hidden cost, asymmetric war, dollar erosion, and the supply chain collapse. Nobody's reporting hook. First 45 seconds. Brent crude crossed $108 this morning. Trump posted on Truth Social, Iran's navy has been destroyed. The regime is over. America won. This is the shortest war in history. Same day. Al Jaber Air Base in Kuwait hit by IRGC missile strike. American soldiers killed. The number was not disclosed. Same day. Gulf-wide insurance premiums surged 340%. Same day. Container traffic through the Suez Canal dropped 61%. Same day. Gas station lines made national news in Japan. Same day. The S&P 500 futures opened 2.1% lower before markets reversed on the victory headline. The reversal lasted 4 hours. Then, reality reasserted itself. Same day. The Israeli shekel hit a 6-month low. The Saudi rial's dollar peg came under its heaviest speculative pressure since 2016. The UAE dirham held, but only because Abu Dhabi's sovereign wealth fund intervened directly in currency markets before New York opened. Trump declared victory. Markets are saying something else. And in the gap between those two realities, exactly that gap, your wealth is disappearing. Not in a single dramatic moment, quietly, systematically. Line item by line item on every bill you pay for the next 18 months. That gap is what mainstream media will never show you. Because showing you the gap would require admitting that victory declarations and economic outcomes are two entirely separate things. They have always been separate. They will always be separate. The question is whether you understand the difference before the bill arrives or after. Section 1. What actually happened? The real ledger of epic fury. The U.S. and Israel executed a coordinated decapitation strike on Ali Khamenei. In conventional military doctrine, this is called regime termination. The theory, the regime collapses, the population rises, a Western-friendly government steps in, oil flows, stability returns. The Middle East, that American planners have wanted since 1979, finally materializes. That was the version that looked clean in Pentagon briefings. What happened instead? Khamenei's death didn't weaken the regime. It radicalized it. Mojtaba Khamenei took power. Unlike his father, Mojtaba is not a pragmatist. He is an ideologue. He doesn't view diplomacy as a tool. He views it as surrender. Where Ali occasionally allowed back-channel negotiations to create economic breathing room, Mojtaba views any contact with Washington as ideological contamination. His first 72 hours. All IRGC naval forces repositioned into the Strait of Hormuz. Hezbollah, Iraqi militia networks, and the Houthis received maximum pressure orders. Every IAEA negotiation was frozen. Iran's ambassador to Oman, the back channel that kept indirect U.S.-Iran communication alive for 2 decades, was recalled to Tehran. Washington expected grief and chaos inside the Revolutionary Guard command structure. They got the opposite: institutional cohesion and an accelerated operations tempo. The IRGC was built for exactly this moment, to function without the supreme leader, to decentralize command in a crisis and continue fighting under any leadership scenario. 40 years of that preparation showed in 72 hours. Trump called it victory. The commanders on the ground are calling it Phase 2. Section 2. The economic physics of asymmetric war. In conventional war, the winner is the side with more firepower. In asymmetric war, the winner is the side that makes the other's economy unsustainable. This is not theory. This is the doctrine Iran has been refining since 1979. Every IRGC commander understands one fundamental truth. The United States cannot sustain domestic political support for a war that raises gas prices, spikes inflation, and returns casualties in classified body bags. So Iran doesn't fight to win militarily. It fights to raise the cost beyond what American voters will accept. Iran doesn't need to close the Strait of Hormuz. It just needs to act like it might. Hormuz, the 1.2 trillion pressure point. Every IRGC maneuver in the Strait triggers insurance premium increases. Every premium increase raises shipping costs. Every shipping cost increase raises the price tag in your store. Japan, South Korea, Taiwan, India, these economies run on Gulf oil. One day of disruption costs billions. And right now, disruption isn't hypothetical, it's ongoing. Brent at $108 this morning. It was $79 at the start of March, a $29 move in 6 weeks. To put that in real terms, the average American household spends roughly $3,000 annually on gasoline. A sustained $29 premium on crude translates to approximately $600 to $800 in additional annual fuel costs per household. That's before the secondary effects. The trucking surcharges embedded in every product that moves by road, The airline fuel surcharges now quietly added to every domestic ticket. The heating oil bills arriving this autumn. Suez collapse. The route nobody wants to take, the Houthis, reactivated on Iran's signal, shut down Red Sea transit. Suez traffic collapsed. The alternative, around the Cape of Good Hope. Extra distance, 6,000 kilometers. Extra time, 14 to 18 days. Extra cost, $1 to $2 million per vessel. That cost gets absorbed somewhere. You already know where. In your grocery receipt, in your electricity bill, in the price of everything that arrives by ship. Container shipping rates from Asia to Europe have already respiked to levels last seen during the 2021-2022 supply chain crisis. The crisis took 18 months to fully pass through to consumer prices. This one is just beginning. Section 3, the invisible weight on the dollar. When the media covers wars, they count missiles, they count ships, they count casualties. Nobody counts currency reserves. Iran doesn't need to defeat American military power. It only needs to sustain uncertainty in the Gulf long enough for the economic consequences to compound. The stagflation trap. Oil at $108 refeeds American inflation through the energy component. The Fed now faces a trap with two exits, and both of them cost you. Option 1, raise rates, suppress inflation. But break the economy, crush the housing market, and spike unemployment. Option 2, hold rates, let inflation run, and silently erode the dollar's purchasing power. Both options cost you. The only question is how. This trap has a name, stagflation, no growth, persistent inflation, and the Fed's toolkit doesn't solve both at the same time. The last time America lived through this combination was 1973 to 1982. 9 years of compressed purchasing power, elevated unemployment, and a housing market that stalled while prices rose. The trigger then was an Arab oil embargo. The trigger now is a Gulf war with no defined endpoint. The silent loss, dollar erosion, doesn't make headlines. It isn't dramatic, it's quiet, steady, cumulative, but the math is brutal. If your savings account yields less than real inflation by 4.8 points annually, every $100,000 you hold loses $4,800 in real purchasing power every year. Not in a crash, not in a single event. Just by sitting there while the war drags on. And the war always drags on longer than the victory speech suggested it would. The 2003 Iraq invasion, mission accomplished banner went up in 6 weeks. The war lasted 20 years. Oil prices more than doubled over the decade that followed. The inflationary tail of that conflict fed directly into the 2008 commodity spike. Pattern recognition is not pessimism. It is the only tool that protects you when the headline says one thing and the price tag says another. Trump is declaring victory. Your dollar's purchasing power is dissolving in silence. Section 4, where the money is actually going. While politicians speak, institutional money moves, and the direction is unmistakable. Defense stocks, Raytheon, Lockheed Martin, Northrop Grumman, averaged 23% gains over the past 6 weeks. These companies profit from active conflict. Their revenue doesn't stop until the fighting stops. Think about what that means structurally. Every missile expended in the Gulf needs to be replaced. Every replacement is a contract. Every contract is a quarterly earnings beat. Wall Street doesn't mourn war, it prices it. The defense sector has been one of the best performing corners of the market during every major Gulf escalation since 1990. This time is no different. Gold crossed 3,180 this morning. Institutional investors are systematically building positions, not as speculation, but as structural protection against dollar depreciation. Central banks in Asia and the Middle East have been net buyers of gold for 18 consecutive months. They understand something the retail investor is still learning. When the reserve currency is under inflationary pressure, hard assets outperform. American shale producers at $108 a barrel are now profitably investing in additional capacity. Devon Energy, ExxonMobil upstream divisions, their earnings calls this quarter will look spectacular. And while all of this happens, fixed income earners and renters absorb the cost quietly. Salary increases trail inflation by months. Energy costs get passed into rent at the next lease renewal. The wealth transfer from wage earners to asset holders that accelerated after 2020 is accelerating again. Powered this time, not by pandemic stimulus, but by Gulf War premium. The winners of Operation Epic Fury, Raytheon, Exxon, Lockheed. The losers, Everyone whose paycheck doesn't adjust for oil prices. Section 5. What mainstream media is not telling you. Every major outlet ran the same story. Mission accomplished. Nuclear program degraded. Regime decapitated. Threat neutralized. Here is what none of them led with. Oil is $29 higher than 6 weeks ago. Gulf insurance premiums tripled. Suez transit collapsed. Global logistics costs are respiking. A U.S. military base in Kuwait was struck and casualties were classified. The victory narrative drives viewership. Inflation will run hot for 18 more months does not. And the question nobody asked on air, if the war is over, why hasn't oil come down? Because the war is not over. One phase ended. The next phase is more expensive. And this phase doesn't have a clean ending that fits a 2-minute segment. The media's job, at its core, has always been to simplify. Simplification requires a winner and a loser, a beginning and an end. The economic consequences of asymmetric Gulf conflict don't simplify. They compound. They bleed into your cost of living 6 months after the cameras left. That bleed is invisible on television. It isn't invisible on your bank statement. Close. Final 60 seconds. Trump declared victory. Mojtaba Khamenei entered his second week in power. Brent crude held above $108. And that $29 difference from the start of March to today is quietly being calculated inside Japanese factories, Korean ports, European heating bills, and American fuel pumps. That number doesn't appear in the victory speech. It doesn't appear in the defense briefing. It appears on your next energy bill, on the price sticker at the grocery store, in the rate your Fed keeps higher for longer because inflation isn't done. The conflict narrative is managed by politicians. The economic outcome is written by markets. Markets don't read press releases. They read oil flow data, insurance premiums, Suez transit numbers, and forward contracts. So do we. Because the only defense against a system that obscures the real cost of conflict is knowing where to look, and looking before everyone else does. That's not a slogan. That's the entire difference between being positioned and being surprised. If this gave you a framework you didn't have before, turn on notifications. What comes next won't be a surprise.